Steve.
Fed officials at the October meeting after their quarter-point rate cut believe that policy would be, quote, well calibrated. That would be to deliver moderate growth, strong labor markets, and inflation near the 2% target. The stance of monetary policy was seen as, quote, likely to remain appropriate after that cut as long as the economy and the economic data came in line with Fed forecasts. Those two bullet points really mean the Fed was thinking it would be on hold for at least some period of time after that quarter-point cut. There were some divisions, though, inside the Fed on this issue. A couple of the participants wanted to state that no cut was coming afterwards. In other words, they wanted to be very explicit about the future path. A couple called the rate cut, quote, a close call. And two, who we know, Rosengren and George, don't know if it was the other couple we talked about earlier, they didn't want to cut at all. The Fed said the cut was due to the trade war, global developments, economic weakness, and to take out what it said, quote, was insurance against potential downside risks. There were concerns, even though recession chance had faded, there was some improvement in Brexit and in trade at the time, there were still concerns that the weakness in manufacturing and in exports would spill into the labor markets and consumer spending. Kind of gives you a clue there what the Fed is really concerned about. They're okay with it, not okay with it, but they're not all that concerned with weakness in manufacturing and exports if it doesn't spill into the labor markets. And they thought that would threaten the economic expansion and further dampen investment in exports. So several said the rate cut would better align, by the way, the funds rate with the neutral rate and with the yield curve. There were some financial stability concerns mentioned in the meeting. High levels of corporate debt were mentioned and elevated values for risky assets. No additional detail on what those risky assets might be. And they discussed what options. There was a staff presentation about what they might do in the next crisis. That included adjusting their balance sheet with additional quantitative easing, different forms of forward guidance, and potentially interest rate caps. Nothing was decided in any of those regards. Of course, the staff also presented plans on how to solve the repo market problem, including a discussion, again, no decision made, on a standing repo facility. We can talk about that in depth if you want, Tyler. But the big takeaway here is that the Fed wanted to send a signal that after that October rate cut, they were on hold for some period of time.
Well, and so that goes to my question, Steve, on hold for some period of time. Based on history, when the Fed releases minutes like this, what does on hold mean in practical terms?
Well, I mean, there were a couple other instances where they did these three rate cuts, and Powell, the Fed chair, who was also the former lawyer, liked to go back and draw from precedent. And those three times they were, I know in the 98 instance, it was a couple years or two or almost 3 years till the Fed got back into the rate cutting game with the NASDAQ bubble and, of course, 9/11 as well. 95, they were neutral. Neutral for Fed policy, of course, Tyler, is a gear. That's them doing something which is not moving the rate. And I think they like to be there for as long as they can. I think the bar is high. I talked to Lael Brainerd this morning. I think the bar is high in both directions for changing rates at this point. And the way the Fed puts it is, as the economy, the economic data has to come in line, has to be really out of line, materially or significantly out of line with what they're looking for in the economy.